Exercise 1.17. The given information for the accounting period 1 March 2024 to 28 February 2025 with comparative figures were obtained from the books of Hoax Limited. Required 1.17.1. Comment on the dividend policy of Hoax Limited for the year ending 28 February 2025. Provide 2 applicable indicators, calculations and figures to substantiate your answer. 1.17.2. Can the company be satisfied with the profit for the year ending 28 February 2025? Provide 1 applicable indicator, calculations, and figures to substantiate your answer. 1.17.3. The company wants to take out a loan to finance further expansions. Do you think it would be a wise decision? Provide 2 applicable indicators with calculations and figures to substantiate your answer. 1.17.4. The directors are satisfied with the liquidity position of the company. Provide 3 applicable indicators and figures to support their opinion. 1.17.5. Should the company be satisfied with the market price of 11.20 Rand per share on the JSE? Provide applicable indicators with calculations and figures to substantiate your answer. Information number 1. We get an extract from the Statement of Comprehensive Income on 28 February 2025 with the revenue, cost of sales, interest on borrowed money, income tax, net profit after tax, and ordinary share dividends, which is the total dividends for the year. So all those amounts are given. Information 2, extract from the Statement of Financial Position on 28 February. They give you for both years ordinary share capital, retained earnings, and mortgage loan APSA. Note 1. Ordinary share capital, 28 February 2024, 120,000 shares in issue, 360,000 Rand. And 28 February 2025, 150,000 shares in issue, 780,000 Rand. Number 3, all these financial indicators are given. Return on equity, earnings per share, net asset value per share, inventory turnover rate, current ratio, dividends per share, debt equity ratio, quick ratio, return on capital employed, debtors collection period, creditors settlement period. Everything for 2024 is given, but there's some question marks that will have to be calculated for year 2025. 1.17.1, we have to comment on the dividend policy of Hoax Limited for the year ended 28 February 2025. Provide 2 applicable indicators, calculations, and figures to substantiate your answer. So obviously the first indicator and calculation will be our dividend per share. Okay, so to calculate the dividend per share, it's your total dividends divided by the issued shares at the end of the year. So if we go to information 1, our total dividend for the year is 120,000 Rand, and our issued shares at the end of the year is 150,000 shares. So 120,000 Rand divided by 150,000 shares times 100 over 1 gives you 80 cents per share. Indicator 2 will be your earnings per share, and that's obviously your net profit after tax divided by your ordinary shares issued for the year times 100 over 1. So it's going to be 600,000 Rand divided by 150,000 ordinary shares times 100 over 1 to give you 400 cents per share. So what would be our comment? So we compare. Our dividends of 80 cents per share is less, that's why I've highlighted it in red, than the earnings per share from 400 cents per share. Thus, what is the difference? 400 minus 80, 320 cents per share are withheld as retained income to finance further growth. 1.17.2. Can the company be satisfied with the profit for the year ending 28 February 2025? Provide 1 applicable indicator, calculations, and figures to substantiate your answer. Well, to answer this question, the first indicator that we are going to use is the return on average shareholders' equity. That'll be your net profit after tax divided by the average capital employed. Now remember, your average capital employed is half of your ordinary share capital plus your retained income for each year. So then if we do the calculation, it is going to be 600,000, which is your profit after tax, divided by half of 360,000 plus 140,000, and then the 780,000 plus the 620,000. We then get 600,000 divided by 950,000 times 100 over 1 to give you 63.16%. And our comment will be yes. That's why I've highlighted it in red. So you first answer the question. The return on average shareholders' equity of 63.16% is much higher than interest rates offered by financial institutions on fixed deposits of more or less 6%. 1.17.3. The company wants to take out a loan to finance expansions. Do you think it would be a wise decision? Provide 2 applicable indicators with calculations and figures to substantiate your answer. So the first indicator that we will use is the debt-equity ratio. Now, our debt-equity ratio, remember, is your non-current liabilities to your shareholders' equity. And your shareholders' equity comprises of your ordinary share capital plus your retained income. So our non-current liabilities will be 490,000, and our shareholders' equity is the 780,000 ordinary share capital plus the 620,000 retained income to give you 1.4 million. So 490,000 divided by 1.4 million gives you 0.3521. The next indicator we will complete is the return on average capital employed. Now your return on average capital employed will be your net profit after tax plus your income tax plus your interest expense times 100 over 1 over your average capital employed. Okay, so our net income after tax is 600,000. Our income tax is 255,000, and our interest expense is 12,500. And your average capital employed, average means half, and that would be your shareholders' equity plus your non-current liabilities for both years. So the 2025 is the 1.4 million plus the 490,000 loan, and for 2024 it's the 500,000 plus the 100,000 loan. And then you get 600,000 plus 255,000 plus 12,500 is 867,500, and we divide by 1,245,000 and we times it by 100 over 1 to get a percentage, and that gives you 69.68%. Now we will comment on the 2 calculations completed. Yes, the debt-equity ratio of 3.5 to 1 implicates the company to be low risk. In other words, it has a low gearing, and financial institutions would be keen to provide additional loans to the company. Return on average capital employed of 69.68% is higher than interest rates on loans offered by banks of about 10%. The company therefore can afford the additional interest as they are positively geared. (1.17.4) The directors are satisfied with the liquidity position of the company. Provide 3 applicable indicators and figures to support their opinion. So the first indicator that I would supply as a reason that they are satisfied is my inventory turnover rate, because it has improved from 4 times to 6 times per year. The second indicator would be your quick ratio, as it's improved from 0.8 to 1.3 to 1. And the third indicator would be your debtors collection period, because it improved from 36 days to 28 days. So the debtors are paying the company back quicker. (1.17.5) Should the company be satisfied with the market price of R11.20 per share on the JSE? Provide applicable indicators with calculations and figures to substantiate your answer. So the indicator I would use is the net asset value per share. And your net asset value per share is your shareholders' equity divided by your issued shares. Now remember, your shareholders' equity is your ordinary share capital plus your retained income amount. And our issued shares is that was issued during the year. So if we go back to the question, it was 1.4 million rand divided by the 150,000 shares times 100 over 1 to give you 933 cents per share. So my comment would be yes, because the market price of R11.20 per share is higher than the net asset value per share of R9.33. This implies investors then does have faith in management of the company, and they see good potential and opportunity for further growth.